Hello, very good morning to all. I'm Kelvin here. Welcome back to today's Daily Dose of Market Insights. I hope that you all have a great, restful, and wonderful weekend. Good morning to all. Welcome to today's Daily Dose. Today will be the Monday, the 30th of September 2024, and as well as the month end of September 2024. So before we start our Daily Dose of Market Insights for today, Monday, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product. As well as any forecast, prediction, projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, before we jump straight into today's gist of market insights on the short-term intraday technical outlook on the various broad-based cross-asset classes, let's have a quick look at what has taken shape over the weekend, and especially on Friday, where I was actually on leave for 2 days on Thursday and Friday. What are the things that has taken shape in terms of news flow, economic data release, and their impact on the various cross-asset classes prices, and as well as I will share with you all one fundamental and intermarket dynamics that is playing out in the market right now before we jump into the short-term intraday technical outlook. So let's start what has taken shape on Friday first. All right, so on Friday during the Asia session, there was some very interesting movement, particularly centered on the Japanese markets, both in terms of the Japanese stock index, the Nikkei 225 and the dollar yen. So what we could see over here is that this was actually, very quickly, let me go to the chart of the dollar yen. Okay, so what we could see over here is that on Friday, the Nikkei 225, not the dollar, the Nikkei 225 or the Japan 225, we call it in our platform, actually rallied. Okay, it added about 2% during the normal cash trading session, and right after the close of the Japanese stock market at 2:30 p.m. Singapore time, the Nikkei 225 or the Japan 225 CFD index actually plunges. All right, over here. So for us, our CFD actually take into account of the Nikkei 225 futures, which also continues to trade after the closure of the normal Japanese cash market trading section, which closed every day at 2:30 p.m. Singapore time. Then thereafter, the futures market starts to actually take movement. So what you see over here is that there was actually a plunge close to negative, overall negative 6%. All right, from the high, you go all the way down to negative around 6%. So this was actually the new Japanese PM Ishaba shock. So we know that the Japanese current incumbent PM decided to step down, and on Friday there was actually a kind of a internal vote among the current ruling LDP party of who will lead the LDP party, eventually who will become the leader of the become the current Japanese PM. So the leadership vote actually went to Ishaba. So what causes this actually a shock in this sell-off in the Japanese stock market or the Nikkei 225 was this current or the new Japanese PM Ishaba. He's more kind of advocating towards very hawkish Japanese monetary policy, because over here he actually backed for future BOJ hikes. All right, so this guy is Ishaba. He's a new Japanese PM who won the LTP vote on Friday, the leadership of the current Japanese political party called LDP. So he will be named as the new Japanese PM for now. But due to his past speeches, he actually advocated for very hawkish monetary policy in Japan. So that actually kind of scare the Japanese stock market, and he might add further pressure for BOJ to induce BOJ to be more aggressive in its monetary policy. And that also causes the Japanese yen, the dollar yen, to actually reverse down from 145 to all the way trade all the way down to this you look at the Japanese yen over here. Okay, previously it went all the way up to 146, 145. Then after that, it also plummeted all the way down as well. All right, during this kind of a shock news flow. But what's interesting over here is that thereafter on Friday, he actually toned down his stances. So what he called that, he did an interview in one of the local Japanese press on Sunday, not Friday, on Sunday, which is late yesterday. he said that rate decision is up to BOJ, working closely with government. That means, i.e., he tried to tone down his so-called hawkish monetary policy stance. That means, i.e., indirectly, he's saying that he will not pressure BOJ to hike rates. And he also made a very strange statement, reversing a kind of a 360-degree stances prior to his much more kind of a strong advocate of higher interest rate in Japan. And he did an interview on Sunday. He said that monetary policy must stay loose given current economic situation. All right. And he also vows to actually compile new spending plan to cushion the blow from inflation. That means much more stimulus policy going forward. So that actually kind of reduces that Friday, we call it negative Nikkei 225 shock. And we saw a bit of a reversal coming up in today's Asia session on the Japan 225 or the Nikkei 225. Later, I'll touch on more about that. So it seems to us that the current Japanese government, led by this new PM, is also looking very closely that he do not want to shake the boat in to create a negative spillover impact on the Japanese stock market by having a very strong advocate of interest rate hike in Japan over here. That means, i.e., yes, interest rate hike will be still there in Japan, but the pace of interest rate hike will be roughly currently data dependent and will not be so as forceful as what he advocated earlier on. So this is the kind of news what they're looking at. And also in today's Asia session, we do see where is it? Yeah, there was also a very kind of a encouraging Japan economic data, which is retail sales, which is came in better than expected. Okay, 2.8% year on year for the month of August, and way above expectation of 2.3% year on year. That was being penciled in as a forecast for this for the month of August, and slightly above 2.7% that was printed in the month of July. So if you look at the trend of Japanese consumer spending, retail sales in Japan, it slowly starts to actually stage a kind of a recovery since the March year to date low of month to date low, I would say, of 1.1% year on year. Okay, so there was a slight so-called uptick. If you look at the trend of 3 years from here, there's actually a continuous recovery. Okay, in motion right now, but still printing a series of lower high, unless it could break up above a June lower high of 3.8%. Then we start to see a series of higher high, higher low. Then that is why I call more or less cemented the ongoing recovery in consumer spending or retail sales in Japan. But nevertheless, it starts to form a higher low, which is pretty much encouraging. Also being reflected by this kind of minor bullish reversal that's being seen in today's Asia session in the Nikkei 225 futures as well. Okay, and also without further ado, let us share what has taken shape this morning, as well as the MBS state release or state compound manufacturing PMI data, as well as the services PMI data. All right, so for the manufacturing PMI data is also kind of hover around the contractionary mode, 49.8, but slightly better than the previous month of August, 49.1. Some signs of encouragement, but the services non-manufacturing PMI continues to actually inch much lower from 50.0 to 50.3 that was printed in the previous month of July, and also came in below expectation of 50.4. But net overall right now, what you could see over here is that the top policy makers in China has already acknowledged this very entrenched deflationary risk spiral that is playing out in China, and right now they try to actually shift their stance to be much more having a kind of a piecemeal stimulus policy to go out all out aggressively to ignite this very strong kind of stimulus expansionary monetary policy, which we highlighted last week by a series of simultaneous policy interest rate cut that has taken shape last week, and also potentially up and coming, there could be much more so stimulus policy coming into play as well. Given last Thursday, there was a kind of much more forceful statement coming out from the political bureau meeting that actually advocate for more, we call it recovery of this weak consumer stimulus planning in December. All right, or in coming up in the months ahead. So what you could see over here is that there was actually a change of tonality in China top policymaker mindset to actually address this deflationary risk spiral. So that actually kickstart a very strong rally last week on the China A-share market as well as the Hong Kong Hang Seng Index. So their weekly gain is close to about 14 to 13%. So that is the strongest weekly gain that was seen so far since the GFC, the onset of the great financial crisis in 2008, 2009. So later I'll touch on more of the chart of the Hang Seng Index to share with you all what is today's intraday outlook will be from a technical perspective. And also on Friday, there was also a US data to take note of, will be the core PCE data. Over here, the PC price data. Okay, let me share with you where was it again. Over here, okay, on Friday. Let me go through where was it. Yeah, this is the one. Okay. Okay, so the core PC price index, that's excluding those volatile items. So this is the inflationary gauge trend, the inflationary trend gauge of the US economy, much more preferred by Federal Reserve officials than the usual, CPI data. So this core PCE price index for month of August, year on year, excluding energy and food prices, it actually came in within expectation, 2.7% year on year. Markets were expecting 2.7% year on year, a slight 1 basis point above 2.6%. So more or less, right, what we could see over here is that if you look at the trend of the core PCE index over here, it continues to actually showing signs of deceleration. All right, over here. So even though it's that show a slight uptick of 1 basis point, but it came within market expectation as well. So no major surprises. So that actually boils down to the fact that we high likely will continue to see a series of interest rate cut going forward in the month of November, December, and going to the early first half of next year as well. But now the big debate over here is that will that be a much more jumbo cut of 50 basis point or a 25 basis point cut? But it seems to me that market participants now are favoring a 50 basis point cut going forward in November, right after the US presidential election. So if you look at the CME Fed Watch 2 over here, so what we could see over here is that the current Fed funds rate is at 4.75%. So okay, if you look at the current one, let's go to the current one first. Okay, so this is the current one, 4.75% to 5%. So it's a range after that 50 basis point cut this month. So what we could see is that market now is looking for a slight chance higher, looking for a 50 basis point. Why? Because if you look at 4.25% is 50 basis point, and the odds as being priced by the CME Fed Watch 2 using this calculation based on the 30-day Fed funds futures has a more than 50% chance, which is at 53.7%. And you look at how the odds change over here. 1 month ago, it was at 10%. 1 week ago, it was 50%. And now it has a slight tick higher than 50% at 53.7. So market is now looking for a current higher chance, a slight higher chance of 50 basis point cut to come in the month of November. So overall, if you look at the aggregated one, where we compile across the meeting date going forward, so 7th of November, market is looking at 50 basis point at 54% chance. Then thereafter, there will be a slowdown at 25 basis point. Over here, 99% chance before the year ends at 18th of December FOMC meeting, bring it down to 4% to 4.5 to 4.25%. Then to kickstart off the new year on the 29th of January 2025 FOMC, market also looking at another high chance of only 25 basis point cut at 3.75% to 4%, all right, 68%. Then market is expecting the 50 basis point cut to resume again in the 19th of March 2025 meeting. Why? Because of the slightly higher 51.5% chance as being currently priced in right now by the CME Fed Watch futures. to bring it down to 3.25% to 3.5%. So this CME FedWatch 5 data is not live data. It's slightly delayed by 1 to 2 hours or around about there, based on the futures contract that is being traded on the CME uh, uh, CME exchange, which is the 30-day Fed Funds futures contract. So net overall, right, by this expectation of this kind of what you call that very we call it constant pricing of a interest rate cut cycle that is right now being entrenched into market participant mindset, that causes the US dollar to remains on the weaker side of the story as well. So if you look at the dollar index, using dollar index as a kind of a gauge of dollar strength or weakness, the dollar index continues to actually be well, we call it on the downside, right below its downward sloping 20-day moving average over here, and also below this 160 level, former swing low area of 28th of December, now turns into a intermediate pullback resistance at 100.60 over here. So what you could see over here is that very clearly the medium-term trend of the US dollar index is still down, as price action continues to trade below the 20 and the 50-day moving average, with a key medium-term pivotal resistance at 101.90/102.70. And the next near medium-term support level, and the next medium-term support level to watch out for will be at 99.60, followed by 97.85 over here. These are the two key support levels. So net from a medium-term perspective, so this is a daily time frame, so it could stretch out from a multi-week perspective over here. The dollar index is still very clearly on the path on the downside, as its medium-term downtrend continues to remain intact over here, and also being supported by that very dovish pricing in the CME FedWatch futures, or the CME 30 days futures contract, indicating that potentially there could be much more constant Fed funds interest rate cut going down the month ahead. Okay, this one to share with you. All right. So with that, that kind of sum up the the daily dose of what I call it previous day key data, and as well as how does it impact the market. So before I touch on the fundamentals and intermarket dynamics, one thing I'll go through very quickly is about the state of the US stock market. So the state of the US stock market continues to be rather mixed over here, even though on the intraday basis as well. So what we could see over here is that the SPX 500 and the Nasdaq 100 continue to underperform on last Friday. So that also doesn't came to much of a big surprise as well. Why? Because in my series of daily dose in the past month, or even the past few weeks, we have been talking about this outperformance of the laggards, which is the Dow Jones Industrial Average and the Russell 2000, to play a catch up against the Nasdaq, the high flying Nasdaq 100, especially, that has been driven by the AI mega cap technology team play that is in place since the start of the year, and even 2 years ago. That will take a backseat right now. Why? Because of the bull steepening of the US Treasury yield curve. So indeed, this continues to play out over here, where the Dow Jones Industrial Average managed to make fresh new all-time high on Friday, closed at 42,313. 313, up by 0.33%, and the Russell 2000 continues to outperform as well, 0.7%, whereas the Nasdaq 100 has failed to make a fresh new highs since ever since the Fed starts to cut its interest rate this month. It failed to make any fresh new high, down negative 0.5%. Also managed to drag down the SPX 500 as well, down a slightly lower magnitude at negative 0.13%. So net overall, if you look at the S&P 500 heat map, this was last Friday, so we see a slew of underperformance in majority of the mega cap technology stocks, whereas Microsoft is down negative 8%, negative 0.8%. Nvidia continues to be the one that is culprit that's dragged down the Nasdaq 100, down negative 2% on Friday. And we have Amazon also down negative 1.7%. The one that is holding the fort will be the three of them, but very lackluster return. Apple positive 0.12% only, Meta almost unchanged, and Google is up 0.89%. So then overall, we see a bit of more softness in the mega cap technology stocks, especially being dragged down by the Nvidia, which is down negative 2%. 5%. So what you could see is that that actually explain the potential intraday underperformance of the Nasdaq 100, whilst the Dow Jones and the Russell 2000 continues to outperform, and we do expect this kind of Dow Jones and Russell 2000 to outperform going into the weeks ahead, and especially into this quarter as well. All right, as the US Treasury bull steepening plays out, yield curve bull steepening plays out. Pardon me. Yeah. So now with that, the fundamental data that I will share with you today will be the continuation of this oil price. Okay, give me a minute. Oops, where it was? Yes, over here. Continuation of the weakness oil price that it could have on the forward-looking inflation expectation has been depicted by the 10-year US 10-year break-even inflation rate and the 5-year break-even inflation rate. So these are all based on market tradable instrument taken from the US Treasury protection bonds. That means it's a tradable instrument. So from there, we are able to get what the market is expecting. 5-year break-even inflation will be taken as 5-year inflation expectation in US and 10-year, 5-year inflation expectation in US based on tradable instrument. Okay, by this dark blue and the light blue line. So you look at the dark blue and the light blue line, all of them are pointing towards 2.15% and 2.03%. So that is more or less within the expectation of the long run inflation target that the Fed hoping to achieve. And this slowdown in the US 10-year break-even inflation and 5-year break-even inflation move hand in hand or direct positive correlation with the movement in the US oil price, which is WTI crude oil price in turquoise green over here. So ever since the May 2022 high, this oil price and the break-even inflation rate, both on the 5 and 10-year, move in hand. That means in direct lockstep, means direct correlation. So what you could see over here is that this I put in here September. There will be about this 2 weeks ago. There was the Fed rate cut. All right, the first Fed rate cut so far after it paused its Fed interest rate hike cycle in the month of July 2023. So as long as oil prices continues to remain weak, that means i.e. not surpassing $80 per barrel, very likely the 10-year break-even rate and the 5-year break-even rate will start to hover around this 2.15 level, 2% level over here. That means they will not spike up, and that will also potentially see the very clear cut of interest rate cut cycle being enacted by the Fed going forward into at least into the first half of next year. So that could also potentially see further US dollar weakness as well. All right, but that got to be careful. Why? Because we got to bear in mind also of this ongoing US presidential election and also the outcome of the US presidential election, especially towards the end of the year. Let's say if Trump wins the US presidential election, because right now, based on the betting markets, if you could see over here, let me go very quickly on the betting markets, the live one called Poly Market US election. What we could see at this point in time, based on the betting markets, the race is neck to neck over here. Let it run for a while, because based on just what I see a while ago, is about 49%, 50%. Yeah. Okay. Yep. So you see, very tight race. So Harris only lead by a small, slim margin of 50% over Trump. So let's say it's not that Harris is leading by a far margin or Trump is leading by a far margin. So there's a lot of potential volatility going forward. So especially, let's say if Trump were to actually kind of win the US presidential election, and during the first quarter of next year, we got to see his policy plan, because one of his policy proposal is to ignite higher trade tariffs against to higher trade tariffs on China products going to US. So it all depends on what kind of policy that he wants to introduce first. So if Trump were to introduce or push forward this kind of very hawkish trade tariffs policy towards China that could potentially spark another round of dollar strength going forward, and potentially we could also potentially see inflation expectation oil prices could actually go up as well. All right, there's an indirectly conduit on that. So something to bear in mind of to actually potentially kind of derail this intermarket dynamics that is playing out right now. All right, so with that actually sum up the today's fundamental and intermarket dynamics I'm share with you on this future US inflation expectation in relation with the WTI crude oil price, and how does it impact the US interest rate cut cycle, and how from this kind of a very much more clear interest rate cut cycle going forward, it could potentially start to see further dollar weakness, at least stretching into the first half of next year. All right. Now, with that, now let us now switch our focus now to a much more shorter term perspective, which is the intraday technical outlook on the broad-based cross asset classes. So with that, let me expand my screen first so that you guys could have a better view on the charts over here. Okay, so give me a couple of seconds. All right, so let me open up my chart. So let us start with the FX market. All right, let's start with the FX market first, starting with the euro dollar. So the euro dollar in the last 2 days managed to actually help at the 20-day moving average, now coming to actually act as a near-term support area close to this minor swing low that managed to find support on Thursday and as well as on Friday, which is at 1.1120. So with that, I will use 1.1120 as my short-term pivotal support level. Still no change, still maintain that intraday bullish bias on the euro dollar. First near-term resistance level to watch will be this minor swing high here that was rejected on Friday as well at 112 figure level. Only a break above 112 figure level potentially exposes the next higher resistance at 112.35, followed by 112.85/113 figure. This level very important. Why? Because it confluences with the long-term secular descending trend line that prevent any significant rally from breaking up. So this long-term significant trend line is being drawn from the peak of April 2008 high, because it has a very significant psychological impact. However, if price refuses to go up and starts to come down and break below 111.12 level, then potentially we may start to see a kind of a very minor corrective pullback decline scenario unfolding with an hourly close below 111.20 short-term pivotal support level to expose the next near-term support zone at 110.90/110.70, followed by 110.50 next over here. All right, so that's for the euro dollar. Sterling dollar also continues to trade on its short-term uptrend phase and the medium-term uptrend phase, as price action continues to hover above the 20-day and the 50-day moving average. And in the very short-term basis, it continues to actually oscillate within this minor ascending trend line from the low of 11th of September. So no change. I will still maintain that short-term intraday bullish bias on the sterling dollar, but slightly adjusting the short-term pivotal support zone at 133.40/133.10. Right, 133.40/133.10. We also confluence with the lower limit of this minor ascending channel that I drew from 12th of September. All right, let's push it back over here. So as long as this any minor dip didn't surpass below 133.40/133.10, we will still maintain that intraday bullish bias on the sterling dollar. First near-term resistance level to watch will be 134.35. That was almost tested on Friday and Thursday. A breakout above this level sees the next near-term resistance coming in at 134.90/135.20, the 1.618 Fibo extension level, and as well as the upper limit of this minor ascending channel. Only an hourly close below 133.10. This short-term pivotal support over here, a breakdown below it, will negate today's bullish bias to see the start of a minor corrective pullback to expose the next near-term support level at 132.50, which correspond to the rising 20-day moving average. Only a breakdown below 122.50 might trigger a much more steeper corrective pullback towards the next support level or next near-term support level at 131.50. Okay, so that's for the sterling dollar. turning our attention will be on the dollar yen, since we touched on the dollar yen earlier. Still recall before I went for my break on Thursday and Friday, we do have a bullish bias, but this bullish bias is only a mean reversion rebound within a short to medium term downtrend, and the mean reversion rebound indeed hit our resistance level at around the 145, 145.50, 146 figure level, and hit the 50-day moving average exactly thereafter. The price reacted off technically. This reinforces by the news flow up from the Japanese PM. The new Japanese PM news flow reacted off exactly at the downward sloping 50-day moving average. And last Friday price action also broke below this former minor ascending channel that managed to keep the mean reversion rebound intact last week, has also been broken down as well, and price also reintegrate back below the 20-day moving average. So based on this current price movement on the dollar yen, not taking into account of any news flow factor, purely technically, it indicates to us that the downtrend has starts to resume. That means, i.e., the medium-term downtrend that has taken shape since July, 3rd of July now, has starts to resume. Okay, resume. That means, i.e., low odds of this mean reversion rebound from the low of 139.24 all the way up to last week high has more or less been ended. So now the next leg over here, what you see is an impulsive down move to resume this medium term downtrend that is still intact since 3rd of July 2024 high, right? By the very bearish reaction candle on last Friday. And if you look at the entire week, over here is also shaped that so-called shooting star candlestick as well, the weekly shooting star right at the 50-day moving average. Okay, so with that, on a shorter term perspective, back to the hourly chart again. So we will flip to a intraday bearish bias with a rather tight stop for today on the intraday basis, using the 20-day moving average acting as a resistance level right now at 143.20, a very tight one. So as long as this 143.20 didn't surpass on the upside, we will flip to a intraday bearish bias on the dollar yen. First support level to watch will be 141.40, right? Unless 141.40 takes us down on the downside, then it may expose the 16th of September minor swing low at 139.70. Okay, a very tight one. But however, if we start to see the price action starts to break up above the 143.20, then potentially we will see a chance of a intraday mean reversion rebound. That means because of the very steep fall, a chance of an intraday mean reversion rebound to retest the next near-term resistance at 144.50. And once you see hit this 144.50, potentially this is the pullback of this former mean ascending channel support, not as the pullback resistance. And if we start to see signs of exhaustion by the formation of the hourly bearish candlestick, then another leg of dollar yen weakness may resume again. And this 144.50 is also a key inflection level as well for the dollar yen bears. Why? Because it actually coincides with the 50% and very closely to the 61.8% 50 Fibonacci retracement ratio, the golden ratio as well, very closely at the 61.8% Fibo retracement, 61.8 Fibonacci retracement ratio. Okay, so that's for the dollar yen short-term intraday technical outlook. Now turning our focus will be on the Aussie dollar. So on the Aussie dollar now, is actually now breaking above a long-term circular descending trend line from the high of February 2021 over here. So since right now we clearly has a breakout over here, intraday breakout right now. So what we could see over here is that at least on the intraday basis, there could be some form of intraday bullish bias over here, but on the intraday basis. But to solidify the change of trend from a sideways movement to much more of a medium-term uptrend move on the Aussie dollar, we still need to have a daily close above this long-term circular descending trend line, acting as a resistance at 69 figure level. So what you could see over here on last Friday, we did have a clear daily closer over here, right? So it's good to monitor on a daily basis, because this was being we call it depicted on the daily chart. But however, on the intraday basis, we may see a bit of push up going forward. So on the intraday technical outlook, before I went on break, we do expect the price to shape a minor pullback. So this minor pullback has indeed taken shape already, hit the support level, and now shaping a series of higher high and higher low. And interestingly, the hourly RSI, there's no signs of a bullish exhaustion, as price continues to shape a higher high as well on last Friday. And what we could see in today's price session, it continues to shape a higher low right above the 50 level mark, indicating continuation of short-term intraday bullish momentum coming into intact. That means on the intraday basis, price action could still push up, but on a daily basis, we got to monitor at the close of the US session whether can it maintain above the 69 figure level. But at least we know on the intraday basis, until now, till the end of the US session, there could be higher chance of hitting higher intraday resistance level. So using a very tight stop level for the short-term pivotal support level will be at 68.70, slightly below 69 figure level over here, which was the breakout point over here, which is slightly lower, just in case of any whipsaw. So 68.70 will be my short-term pivotal support level, flip to a intraday bullish bias, but first resistance level to watch out for will be at 69.80 level. All right, 69.80 level, followed by 70.10. Okay, so this 69.80 level is a Fibo extension cluster level, and as well as excuse me, as well as the upper limit of this minor ascending channel that I drew from 11th of September. Only hourly close below 68.70 will invalidate today's intraday bullish bias to kickstart another round of minor corrective pullback scenario on the Aussie dollar to re-expose 68.25, followed by 67.86. Next near-term support levels to watch, which is also correspond to the rising 20-day moving average. Okay, so that's for the Aussie dollar, and also sum up the intraday technical outlook on the US dollar major pairs. Now, turning our extension will be the Asia stock indices. So starting with the Japan 225, since we talked about the Japan 225 earlier on. So this Japan 225, what's interesting over here is before I went on a short break, the Japan 225 indeed rally hit our resistance level, and it came down due to this new Japanese PM Ishaba shock. And what interesting over here is that purely based on a technical perspective, price action has started to shape a bullish element again. So why do I say so? Price hit exactly at the 20-day and the 50-day moving average, both of them acting as a support level, shaping a bounce, a strong bounce in today's Asia session. We could see over here a strong bounce up over here, and prior to this strong bounce up over here, the hourly RSI also shaped a bullish divergence as well. What you could see here is a lower high, okay, a higher a higher low, pardon me, a higher low, whilst price action shaped lower low right exactly at the 20 and the 50-day moving average. So this bullish divergence, that means a pair of higher low, indicating that that's bearish momentum from last Friday has eased off, and potentially there's higher odds of at least an intraday potential bullish reversal in play, just purely from a technical perspective on the Japan 225, i.e. Nikkei 225. So using 37,410 as my short-term pivotal support for today, we will still maintain that intraday bullish bias despite that 6% sell-off on last Friday. First near-term resistance zone to watch out for with 38,620 / 38,920 level over here. A clearance above this level, potentially revisit last Friday's minor swing high at 39,790, at least in the first step. Only a price push down below 37,410, then that would invalidate today's intraday bullish bias to see the continuation of this minor corrective pullback, the extension on last Friday weakness or last Friday sell off towards the next near-term supports level at 37,090, followed by 36,740. Right, so that's for the Japan 225, i.e. Nikkei 225. Now, turning our attention to the Hong Kong 33 index over here, or the Hang Seng index. So the Hang Seng index over here continues to push up higher over here. So what initially did this has been the short-term pivotal resistance already been met. So there is no signs of a bearish exhaustion at all. So what I could see over here is that price continues to break out over here, inch up higher, and manage to shape a higher low. All right, so given that there is no clear signs of a bearish exhaustion, we will still maintain a kind of bullish bias using last Friday minor swing low over here. So this was the very clear minor swing low that we have. Okay, so this will be the short-term pivotal support level. Okay, SD pivot. So this will be the first resistance level to watch. Okay, initially, before I went for a break, we're looking for a minor pullback. Still recall on Wednesday that after this pullback, it almost hit the support level. Then it continues to shape this impulsive up mover on the Hong Kong 33, i.e. Hang Seng Index, all driven by very aggressive expansionary monetary policy, and potentially it could be matched by also expansionary fiscal policy as well, due to the much more forceful political bureau statement that was released on Thursday. Okay, so let me tally up the levels. Okay, so what I could see is that as long as 20,240 short-term pivotal support holds for now on the Hong Kong 33, above 21,260 potentially sees the price action of the Hong Kong 33 testing the higher resistance level at 21,710/21,250, which is the one-time Fibo extension level, followed by 22,660. What's this thing? 22,660, 1.236 Fibo extension level. And if we go to the daily time frame chart over here, is this very clear, important medium-term swing high area of 26th of Jan 2023. So this is the current year to date high over here, the current year to date high, and also the potential neckline of this double bottom formation. Okay, first bottom, second bottom. Okay, neckline resistance at 22,660. Okay, so these are the key levels on the upside, but only hourly close. That means it's i.e. if the Hong Kong 33 instead of pushing up and it break down below 22,240, then this impulsive up move sequence for today will be invalidated to see the price action pushing down lower to 19,790, followed by 18,980 over here. So that's for the Hong Kong 33. So bear in mind the Hong Kong 33 tomorrow, the Hang Seng stock market will be closed for tomorrow, 1st of October, to celebrate China National Day. Closed for one day, and they will resume trading from 2nd of October onwards. That means on Wednesday all the way up to Friday, 4th of October. But however, the China local market, the A shares, not the Hong Kong Stock Index, the China stock market, the A shares, will close starting from tomorrow for an entire 1 week to celebrate the Golden Week National Day break. That means all the way from 1st of October, stretching all the way up to the 7th of October. So that's a higher, longer break for the China A shares market. Okay, with that, that sum up the Hong Kong 33 short-term technical outlook. Turning our focus will be the German 30. So the German 30 right now is also trading very closely with the China stock market and as well as the Hong Kong stock index. Why? Is primarily also driven by the China stimulus policy as well, the very strong expansionary monetary policy, because the faith of the China economy has a very strong direct correlation with the faith of the Eurozone. Bear in mind that a lot of Eurozone European luxury brand are dependent on China consumer spending, and some of the parts of China industrial manufacturing parts also being flow into China EV products as well. All right, to actually formulate the final product in China. So that actually explained to us the very strong movement on the German DAX last week. All right, so with that, I got to respect this strong movement, and also given that there's no clear sign of a bullish exhaustion that's being seen on the Hang Seng Index of the Hong Kong 33, we got to flip into an intraday bullish bias on the German 30 index. But with the RSI now at the overbought level, hovering at a kind of overbought level, potentially there could be a minor pullback taking shape first. So first support level to watch on the minor pullback will be at 19,245. Second support level will be the very key support level that was taken out last week, former minor swing high of Thursday and Tuesday over here, last Tuesday, clearly broken out, now turns into a key pullback support area. So two pullback support level to watch for this risk of a minor pullback taking shape on the German 30 before resuming its short-term intraday bullish trend. So as long as this minor pullback didn't surpass below 19,050 level, we will flip to a short-term intraday bullish bias on the German 30. Next near-term resistance level to watch will be at 19,550 FIBO extension on one time, followed by 19,690/19,750, which is also a 1.236 FIBO extension level. Only an hourly close below 19,050 will invalidate today's intraday bullish bias to see a much more deeper corrective minor pullback to revisit 18,820 followed by 18,690. We also correspond to the rising 20-day moving average as well. Okay, that's for the German 30. Turning our attention next will be the US Wall Street 30 over here. So the US Wall Street 30 continues to hit a fresh new all-time high, which is our resistance level as well. So before I went on break, I turned neutral because of mixed stand. So after breaking above the upper neutrality limit at this 42,300 level, it hit the next resistance level before shaping that pullback in the late US session on Friday. So over here, net RSI continues to hover above the 50 level mark, indicating some signs of healthy intraday bullish momentum during the Asia session so far right now. So I will use 41,950 instead of 42,200 level. This is a bit tight over here. So 41,950 very clearly being supported since Thursday of 19th of September. Okay, and it was rebounded on last Thursday as well, shaping this V-shaped rebound. So using 41,950 short-term pivotal support level. So as long as it didn't surpass, any pullback didn't surpass below 41,950, we will still maintain this short-term intraday bullish bias. We'll flip to a short-term intraday bullish bias on the US Wall Street 30. Above 42,730 potentially may expose the next near-term resistance level at 43,170, pardon me, 43,170. How do I define this? The one-time FIBO extension level, we could see over here, taken from the low of 5th of August and as well as the minor ascending channel from the low of 5th of August upper limit. Okay, the upper limit of this minor ascending channel as well, that's confluence with the one-time FIBO extension level. However, if the price have an hourly close below 41.95, 41,950, pardon me, 41,950 short-term pivotal support, then that would invalidate today's intraday bullish bias to kickstart a minor corrective pullback to expose the next near-term support level at 41,535, followed by 41,120. So that's for the Wall Street 30. Turning our attention now will be the Nasdaq 100. So the Nasdaq 100 appears to be much weaker than the US Wall Street 30. Why? Because the hourly RSI has hovered below the 50 level mark. All right, so with that over here, potentially there could be a minor pullback taking shape after hitting the resistance level. We turned neutral, still recall we turned neutral on last Friday, or on before I went on leave, between this 20,000 level and the 19,630 level. So price action broke above the 20,000 level and hit the next resistance at 20,360 level. But given because of the lackluster hourly RSI reading below the 50 level mark over here, then if we were to actually I will actually flip to an intraday bearish bias using for sure last Friday or last Thursday as my short-term pivotal resistance for today, 20,360 level. Okay, that was Thursday level, 20,360 level as my short-term pivotal resistance level. Near-term support level to watch for this potential minor pullback scenario to play out, 19,830 followed by 19,630. Okay, these are the two near-term support level, 19,830, 19,630 level. All right, but for sure, the odds to see this minor pullback taking shape will be the breakdown of 20,000. All right, that's testing at it right now as we speak. But however, if price action starts to break out again above the 20,360 with hourly close above it, then it would invalidate today's intraday bearish bias for that minor corrective pullback to seek out new resistance level, higher resistance level at 20,615, followed by the current all-time high that was printed in July at 20,790 next. So that's for the Nasdaq 100. All right, now turning our attention, our next focus will be on the commodities market, starting with gold XAU/USD. So for gold XAU/USD, no change. Price action to continues to hover above the short-term pivotal support that we still remains intact since last Wednesday before I went on a break. 2,640 will still be the short-term pivotal support level to watch, and right now it's also trying to hold at the median line of this ascending channel that I drew from 9th of September after hitting the upper limit on Thursday. This minor pullback over here. So as long as 2,640 short-term pivotal support holds, we will still maintain our short-term intraday bullish bias on gold XAU/USD. Next resistance level to watch, or the first resistance level to watch, will be 2,692, which is the 1.236 Fibo extension level. However, only an hourly close below 2,640 means a breakdown of the hourly close below 2,640, then that would invalidate today's intraday bullish bias to kickstart a kind of a minor corrective pullback scenario to expose 2,615 level, which is the minor swing, the minor ascending channel support, 2,615. Breakdown below 2,615, potentially seek out 2,591, 2,571 over here, okay, which correspond to the 20-day moving average as well. That is acting as a support. Okay, so that's for gold XAU/USD. And lastly, West Texas crude oil. So West Texas crude oil over here continues to plunge as expected after the retest of that former medium-term symmetrical triangle support now turns into a pullback resistance level at 73.15 and hit our support level on last Friday. So with that, I continues to have a short-term intraday bearish bias, but with a tightened key short-term pivotal resistance now, since it has reintegrated back below the 20-day moving average. So using 71 figure level, which is last Thursday minor swing high, and so correspond very closely to the 20-day moving average, now acting as a resistance around 70.40. So 71 figure level, tighten short-term pivotal resistance on the West Texas crude oil, maintain the intraday bearish bias. First near-term support level to watch, 68.15. A breakdown below it, revisit the swing low area of 10th of September and 11th of September at 65.90. Only an hourly close above 71 figure level will invalidate today's intraday bearish bias to see another round of choppy push up again to revisit 73.15 resistance level. All right. That's for the West Texas oil. So before we go, let us have a quick look at the economic calendar to see what are the key events to look out for today. So for today, we do have key Eurozone economy inflation rate data out. That's for the preliminary one for the month of September. So for Germany, inflation data for the month of September, so that's a flash figure or a preliminary figure, will be out at 8 p.m. Singapore time for today. We do have a Fed official speaking today, Fed Bowman, speaking at 8:50 p.m. Singapore time. And thereafter, the boss, Fed Chair Powell, he will be speaking at 1:55 a.m. Singapore time today. And that should actually sum up today's daily dose of market insights. I'm Kelvin here, so signing off, and I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.